In the often opaque world of taxation, one mechanism stands out for its complexity and its mission: the Canadian Dividend Tax Credit, DTC. For investors, it can feel like a cryptic cipher, yet it holds profound implications for your after tax returns, your choice of investments, and for business owners, your exit strategies. This takes you on a dramatic deep dive into the DTC, what it is, why it matters, how it works in painful detail, the subtle traps, and how to use it wisely. The story behind the credit. At its core, the DTC exists because of one age old problem: double taxation. A corporation earns income, pays corporate income tax, then it distributes a dividend to a shareholder, and the shareholder pays personal income tax on that money. Without any remedy, the same dollar of economic income would be taxed twice: once in the corporate world, once in the personal world. That would, to use the jargon, disrupt tax integration. The DTC is the vehicle the Canadian tax system uses to offset, but not always eliminate, that double taxation. As the government puts it, the credit is applied to reduce the individual's tax liability. The dividend tax credit is intended to compensate the individual for corporate income tax, which is presumed to have been paid by the corporation on the income that funded the dividend. In layman's terms, you get a dividend, you're taxed on it, but the tax system recognizes that the corporation already paid tax. So you get a credit, i.e., a reduction on the tax you owe, in recognition of the corporate tax that should have been paid on your behalf. Eligible versus non-eligible dividends, the two dramatic paths. The mechanics of the DTC hinge on a crucial distinction: eligible dividends versus non-eligible or other than eligible dividends. Eligible dividends typically come from public corporations or private corporations not benefiting from the small business deduction that pay tax at the general corporate rate. These dividends receive the enhanced treatment, higher gross up, higher credit, because the corporation's underlying tax burden was higher. Non-eligible dividends come from Canadian-controlled private corporations, CCPCs, paying tax at the lower small business rate. Because the tax burden at the corporate level is less, the credit is smaller. Importantly, foreign dividends do not qualify for the DTC. That means if you own shares in a US corporation, for example, you won't get this relief. Why does the distinction matter? Because the difference drives how much tax you owe and whether your tax might even go negative in rare cases for dividend income. More on that later. The mechanic in action: gross up plus credit. Here's where things get dramatic and math laden. Step 1: gross up. And when you receive a dividend from a Canadian corporation, you must report not just the cash you received, but an inflated, grossed up amount. Why inflated? Because it aims to pretend you earned pre-corporate tax income, the logic being that the corporation's tax should be imputed to you, so that personal tax plus corporate tax approximately what would have been paid if you earned the income directly. For eligible dividends, the gross up is 38% of the actual dividend. For non-eligible dividends, the gross up is 15% or around that of the actual dividend. So if you received $1,000 of eligible dividends, you'd report $1,380 as taxable dividend income. Step 2: apply your marginal tax rate. You pay personal income tax on that $1,380, in our example, at your marginal tax rate, federal plus provincial. Step 3: apply the dividend tax credit. Then you deduct the DTC, which is a non-refundable credit, to reflect the corporate tax the company paid. For the federal portion, for eligible dividends, the rate is 15.0198% of the taxable, the grossed up amount. For non-eligible dividends, federal is 9.0301% of the taxable amount. For provincial credits, each province/territory has its own rates depending on eligible versus non-eligible. For example, in Ontario, the credit for eligible dividends is 10%, and for other than eligible, it is 2.9863%. A quick example: let's say you get $1,000 in eligible dividends, grossed up $1,380. You're in a combined top tax bracket of, say, 43%. On $1,380, you owe $593.40. Then the federal credit reduces your tax by $1,380 times 15.0198% equals $207.27. Ontario credit adds $1,380 times 10% equals $138. So your tax equals $593.40 minus $345.27 equals $248.27. 13 cents. So effectively, you paid approximately 24.8% tax on the $1,000 dividend instead of perhaps 43%, which shows the system works in its objective of lowering the tax bite on Canadian dividends compared to regular interest income. Interest income doesn't get a gross up plus credit. Why it matters, strategic implications. 1. Holding Canadian dividend paying stocks. If you invest in Canadian corporations that pay eligible dividends, the DTC means your after tax yield is higher than it would appear at first glance. Many investors use this to build dividend income streams. Some commentators say dividends paid to you by Canadian corporations are taxed at a lower rate than interest income, thanks to the dividend tax credit. 2. Business owner considerations. If you operate a corporation and are deciding between salary or dividends, you need to understand how non eligible dividends from CPCPS get treated because the credit is smaller and your marginal tax rate could be higher. 3. Provincial differences matter. Because provinces' territories each have their variation of credit rates, your province of residence affects how much benefit you get from Canadian dividends versus foreign dividends. For example, some provinces' gross up slash credit combination may yield very low effective tax rates for eligible dividends in lower income brackets. 4. Impact on income tested benefits. Be careful, the grossed up amount enters your taxable income, which may affect income tested benefits, like the Guaranteed Income Supplement, GIS, OAS clawback, or other credits. Some investors forget that the grossed up, not just the cash, counts. Right, a $1,000 dividend might inflate your income by $1,380 for benefit testing. The caveats and criticisms. 1. Not a universal tax reduction. Although the DTC reduces your tax on Canadian dividend income, it does not guarantee you pay no tax. The amount you owe still depends on your marginal tax rate, your province, and whether the dividend is eligible or non-eligible. Some pay much more tax on non-eligible dividends. 2. Foreign dividends get no relief. Dividends from non-Canadian corporations do not qualify for the DTC, so if you hold US stocks in a non-registered taxable account, you'll pay full personal tax and possibly have foreign withholding tax without the benefit of gross up and credit. That's less favorable. How to use it wisely. Given the drama of the mechanics, here are some strategic tips to make the DTC serve you. Distinguish eligible versus non-eligible dividends. Always check whether dividends are designated eligible. Your T5, T3, or other slip should indicate it. The tax treatment differs materially. Consider where to hold your investments in taxable, non-registered accounts. Canadian eligible dividends get the favor of the DTC. Foreign dividends don't. In registered accounts, TFSA, RSP, dividends, Canadian or foreign, grow tax-free or tax-deferred anyway, so DTC mechanics are irrelevant. Be mindful of your total taxable income. Because of the gross up, your income may rise significantly, which may affect other tax attributes, income-tested benefits, phase-outs, OAS/GIS, etc. Make sure to run the numbers. Plan business owner payouts carefully. If you're running a CCPC and paying out dividends to yourself or via spouse, know that non-eligible dividends have less favorable credit and may result in higher effective personal tax. Consider salary versus dividend trade-offs and the interplay with corporate tax. Factor in provincial or territorial differences. Provincial dividend tax credit rates vary, and so do effective tax rates on dividends by province. If you move or live partly in another province, your residence matters. Integrate with your overall income strategy. A portfolio of dividend-paying Canadian shares may make sense as part of retirement income, but don't assume tax relief alone means dividends are always better than capital gains or interest. Other factors, liquidity, portfolio growth, tax bracket, timing, still matter. When you strip away the legalese, the DTC is a dramatic and elegant mechanism, a tax system engineering solution to the unfairness of double taxation. It says, yes, you earned a dividend from a Canadian company. Yes, the company paid tax. And yes, you deserve relief for that corporate tax when you pay your personal tax. And when you use that mechanism thoughtfully, knowing whether the dividend is eligible, how much you'll be taxed, what your province's rules are, you can turn what looks like a normal dividend payment into a strategically efficient stream of investment income. On the flip side, misunderstand it, ignore the gross up, ignore provincial nuances or benefit clawbacks, and you can end up with surprises. higher tax, lost benefits, or suboptimal payouts. For the investor, as well as the business owner, mastering the DTC opens a pathway to more nuanced tax planning. The drama lies in the numbers, but if you step into it armed with understanding, you may just turn that complexity into a competitive edge. If you find this educative, please consider giving it a like and subscribe to the channel for more from Dividends and Dollars.